Hi there, welcome back to You Heard It from CFP. My name is Matthew Coyle, back with you for episode 55 of You Heard It from our offices here in downtown Minneapolis. Hope you are well and thank you for watching. Today we're going to talk about one of the smartest things that you can do with your money over the long term. The friend you never knew you had in personal finance. It's American as apple pie, it's been around forever, and you probably didn't know how valuable it actually was. Let's talk about the unsung hero of personal finance, your friend and mine. All hail the mortgage. Well, having a mortgage in today's economy is actually one of the smartest things you can do financially with your money. And you may not spend much time thinking about your mortgage, but I do. And I've got 5 reasons why you should love your mortgage as much as I love your mortgage. Let's start with number 1, the fact that it is a social good. And it does require a really brief history on where the mortgage came from and how we got to the point we got to now. Very interesting, actually. I'll keep it very brief. Back in the 1920s, pre-Great Depression, most people in this country could not afford or managed to purchase a home. Lending requirements were very strict. Most mortgages were underwritten at the time. Contracts were done by insurance companies, not by banks like we have today. So the mortgage was typically a 3 to 5 year contract with a balloon payment at the end, which for most families just was not doable. They could not afford to do that unless they were well connected or from a wealthy family. Owning real estate just wasn't a realistic venture or opportunity for most Americans, and that's why home ownership rates back in the 1920s, pre-Great Depression, hovered somewhere in the 30 to 35% range in most parts of the country. Fast forward to the Great Depression. During that time, FDR ordered the purchase of over 1 million underwater mortgages by the federal government, using the power of the federal government to refinance those mortgages, to keep people in their homes, to keep people in their communities, to keep those communities tight. And subsequently, homeownership rates went from roughly 30 or 35% back in the 1920s, all the way up to near 70% in the 1980s and 90s. So that is kind of how we got to where we are today. It strengthened communities. It created the modern 15 and 30 year mortgage structure, and it is considered by our government and by many people around the world to be a social good that keeps communities tight together. So that's number 1. It is a social good, deemed to be that by our government and by our communities. All right, number 2, it helps you build wealth faster in other areas of your life. When you make your mortgage payment, of course, a portion of that payment is going toward interest and a portion is going toward building home equity. Home equity is a 0% rate of return asset. It always has been, and it always will be. It doesn't matter what part of the country you live in, whether it's my home city of Minneapolis or whether you live in Miami or Memphis or Marshalltown. It doesn't matter. Anywhere in the country, you are going to have a 0% rate of return asset when you are building home equity. The ability to have a mortgage spreads that payment out. I can then take additional monies from my pocket and invest in other people's projects, which might be and probably are going to be more productive. Shares of stock, if you qualify, private equity or other businesses, or maybe even start your own business that would have a higher rate of return. So it allows you to build equity and value outside of your home at a faster pace than you normally would had you had to commit those monies to a larger mortgage payment or a more accelerated schedule. All right, number 3, it is a portfolio hedge. Your mortgage allows you to treat your assets like an actual professional money manager would treat their assets. Your home equity and the way you build it and how quickly you build it is part of your overall portfolio. Now, this is piggybacking on what I just said in number 2, allowing you to build wealth outside of your mortgage faster and outside of your home equity faster. Because of that, you can treat your money as a professional money manager would treat it. You must look at everything that you own as a portfolio, and your home equity is part of that portfolio. It's a very low risk part of your portfolio, but it is a part of your portfolio and part of everything that you own collectively. So when I'm building equity inside of my home, I consider it to be almost like I'm owning almost like a cash fund or a low risk type of fund. It acts as a portfolio hedge that allows me to invest in other assets over time. And again, piggybacking on number 2 I just mentioned, but it allows you to treat your entire picture of assets that you own as just that, as one large portfolio, and it acts as effectively a portfolio hedge over the long term. All right, number 4, it's a risk-sharing mechanism. That's what a mortgage really is. There are 2 promises being made in a mortgage. We're all familiar with the first one, right? You promise to pay for this piece of property over a period of time with payments, part of its interest, part of its principal. But the other bigger promise that the bank is making back to you and the risk that they're taking is that, simply put, you may not pay them back. You may come to decide over a certain period of time that maybe this property isn't worth it, or maybe this property is in a poor location, or maybe it's not where I want to be. Taking that risk for you over 3 to 5 years, like you used to do in the old days, was a very risky proposition for a family. Again, unless you're a very well-connected, wealthy family, that was a very, very big risk for the average family to take. The bank is willing to promise to you over 15, 20, 30 years, whatever your contract is, that they're willing to take that risk with you and to finance the property on which you may or may not choose to pay back at some point. Yes, there are workout periods. Yes, there's laws that protect you that didn't exist before, but really at its heart and its soul, a mortgage is a risk-sharing tool where the bank is telling you, hey, we are willing to take this risk alongside of you, and if they are willing to do that, here's a hint. Let them do it. Let them do it. Let them share the risk with you. Let them take the risk alongside of you so that you don't have to take it in 3 to 5 years and invest all of your money in one large piece of property or one property at all, when you can take that, spread it around, share the risk, and do that over the long term rather than doing it over the short term. And finally, number 5, it's an inflation hedge. I kept this for last simply because it's very relevant to what we're going through right now in the economy. Your mortgage is an inflation hedge. It's a portion of your cost that you must endure every month to have a place to live, to build equity, etc., that is not subject to inflation. Really, you should not be taking an adjustable mortgage unless you really need to. Most mortgages really should be fixed mortgages, and most mortgages shouldn't exceed about a third of what your gross pay is. So if you're following good underwriting guidelines and the bank is taking the appropriate risks and you're making a good decision, realistically, you should have a portion of about a third of your income, maybe a little bit less, that is completely protected from the influence of inflation. It is a very, very important hedge against inflation in a very core part of what you're spending every month on a place to live. And it's one of the last few places left that is not subject to inflation if you're on a fixed rate mortgage. Your food costs, your energy costs, your transportation costs, clothing, everything is all subject to inflation. Your mortgage, if it's fixed, and most of them are, that portion of your spending is completely protected from inflation. And you probably rarely think about your mortgage as an inflation hedge, but that's exactly what it is. So those are 5 reasons why I love the mortgage and you should love the mortgage. I hope I never pay mine off. I don't intend to. I pay it as contracted. I never accelerate my mortgage. I make other investments outside of my home if I'm going to do that. And that's how I treat it. So if you have questions on this video, or maybe you just totally disagree with me, whatever, feel free to connect. I always put my email at the end of these videos. Thank you very much for watching as always. Your most valuable asset, and I always say this, and it's true, is your time, and I appreciate yours. Have a very nice day and take care. I appreciate it. Thanks again.